Okay, I think we probably would like to start now. Okay.
So just follow us.
Good morning, everyone. So welcome to ABFER webinar series. So this webinar series is collaborated with the Becker Institute China and the US Business School and the Shanghai Advanced Institute of Finance, Department of Economics, and the Chinese University Hong Kong, and the Chinese University Hong Kong Shenzhen. So we will have our presentation 25 minutes and discussion 25 minutes. We will have roughly about 10 minutes and for Q&A. So our presenter is Professor Bernard Yang, the chair professor, Southern University of Science Technology, Emeritus professor, NUS Business School, National University Singapore, and also council member and Emeritus president, ABFER. And the paper he will present is titled Digital Technology, Legal Reforms and Bank Lending. And Bernard, please go ahead.
Thank you. Thanks a lot for the introduction, and thanks in advance to Vikrant for willing to discuss this paper. We really look forward to learning from the discussion and all the audience. Please allow me to share now the screen. Let's see if it works or not. Okay, so full screen, is it working? Yeah. Good. Okay. Well, this paper is Digital Technology, Legal Reforms, and Bank Lending. This is the first time really we present this in public. We have 5 co-authors in the paper, HUANG, Yuchao, PENG, Yangfan, Nanxuan, WANG, and myself. YEUNG is at the Bank for International Settlement. Yuchao et al. Are in Beijing, and I am in between Singapore and Shenzhen. On behalf of Yi, I want to express that the views expressed in this presentation are our own, not necessarily reflect those of the BIS. So let me start it. Bank financing is dominant in many economies. There's a long literature, and the studies span the various locations ranging from the US to India to China to Brazil and so on and so forth. Let me skip and save time on what the literature says, but focus on 2 big important points that we build on in the literature. The first one is due to the work of Hasman et al. And our discussion. The changes in collateral law matters more than change in bankruptcy. Their point is that the former enhance the likelihood that creditors can realize their claims against delinquent debtors. Then the other one is the improvement in court efficiency, enhance credit availability, and stimulate business investment. These are the 2 key points we are building on. Improvement in liquidating collaterals so as to get compensated in case of delinquency, and also improvement in the court efficiency. It turns out that in today's world, with all the digitals and so on, it's possible to adopt online auctions of collaterals. It's simple. It's easy to do improvement without making a lot of changes in law, and the technology allow very speedy recovery, and also it bypass a lot of the time-consuming bankruptcy procedures and setting up of the committees, etc., and will avoid a lot of the conflicting interest effort and spending on co-opting judges and bankruptcy committees. So we believe that online auction of collaterals would be an efficient solution. And if there is an exposed efficient solution, it can elevate the ex-ante value of loans and change the landscape. Around the world, advanced countries like the US, Germany, UK, India and China, and you can find this whether you are using ChatGPT or DeepSeek or everything. They really come up with this. And what I know is that countries like Malaysia in private is already trying to do something like this. So using online auction of collateral would be useful, and it is going to be useful in emerging economies, even though they need some infrastructure and a very simple change in the legal procedure. Our objective is to use a staggered DID to trace through the effect of this using China as a case in point. And we want to examine how this impact on loan distributions and interest rate spreads, and also the heterogeneous impact on the lending and borrowing. So let me put this into the Chinese context. China tried to improve its bankruptcy. I remember when I was still at NYU, the Wall Street Journal featured a big story about, bankruptcy law is emerging in China. Fast forward 10 years later and so on, China has already made a lot of progress in improving the bankruptcy law. And people like Jacopo and Nibo, they have contributed a lot in this literature. And also Wang have done a lot on how China is improving the legal procedures and so on and so forth. And then it moved, but then at the beginning, it was like the bankruptcy court, when I failed to pay Vikrant, for example, he will sue me to the court. The court will decide to set up a bankruptcy committee and find the companies to auctions and so on and so forth. Then in September 2012, the civil procedure law has revised it, and excuse me, I need to. It turned out that in September 12th, the civil procedure law has revised it to prioritize the use of auction, meaning that courts can directly and independently organize auctions. They don't have to go through all these procedures that's vulnerable to corruption. Then in June 2013, the Intermediate People's Court of Ningbo decided to team up with Alibaba, and then they go to do an online auction via the Taobao platform, and it's fully transparent, wide participation, and there could be market pricing and so on and so forth. And the judges and the creditors love this because the judges' KPI are to handle more cases and to reduce the backlog. And this availability, using the online auction make them able to handle a lot more bankruptcy cases and move away a lot of the backlog cases. And also they will get less blame. So very quickly, this spread out in the country that this map shows from 2013 to 2015, 2017, the whole country is already using this procedure. So given the adoption of this thing, so we asked the question, we asked the research question, for the lenders, raising the post-bankruptcy value means raising the ex-ante value. For the borrowers, that means that they would be able to have more secured loans, and then they would drive up the demand, maybe at a lower interest spread. So our empirical question is, first, would there be substitution away from secured loans? Second, how it impact on the interest rates and the default risk? And third, how do the lenders and the borrowers split the ex-ante determined increase in value of secured loans? Then we are going to do staggered DID. Our identification strategy rely on that. The decision to adopt online judicial actions at the prefectural level, city level, is really exogenous to the region's current and anticipated future economic conditions. We say this because we search the state departments, what they say, and it turned out that the reform is for broader purpose of from the central bank, and they set up an interprovincial circuit tribunals that really the senior judicial officers above the local level drive the reforms at the provincial level or at the national level. And the thing is that they advocate that we have to deepen the legal reform, promote the construction of a law-based climate, and promote judicial independence, and no explicit consideration on no explicit economic conditions was cited as a determinant of the decision. So we think that maybe the decision is really exogenous. And there's a piece of empirical work by Yuchao et al. And they show that the judicial reform has no correlation with local economic indicators, such as GDP per capita or something like that. And if the GDP per capita follow an AR1 process, we can claim that the decision is uncorrelated with expected future GDP. So with this with this idea in mind, we start our DID. And there's a long thing about our data and so on. I'll be very fast on this to save time. The thing that I want you to pay attention to is that our data is from 2011 to 2017. And then the data is a 10% sample of a very major bank of China. And this bank take about 25% of the Chinese loan market. And so we have roughly about 2.5% sample. It's not too bad, I think, and I hope you agree. So now let's start. Our first question is whether there's a change in the loan composition. So what we do is that we first look at branch by branch. Our data is at the branch side level, can be done at the city level, and the result, whether it's a branch or city, are the same. So I report the branch level. And so our dependent variable is secured loan over total loan. We want to check whether a substitution goes on. We control for the branch fixed effect and year fixed effect and cluster the city and year two-way. Then we find out that the online has increased. Then we go further and say, okay, the online dummy indicate that after the reform, secured loan has increased as a ratio of total. What drives this? We look at POE and SOEs. We look at POE secured loan over total, POE unsecured loan over total, and the screen show that the POE secured loan over total also increased after the online reform. And then for unsecured, it drops. So this says that among the POEs, there is a substitution away from the secured from the unsecured to the secured. When we go to SOEs, we don't find similar result. I think this is reasonable because in the case of China, the SOEs, they do have a special status. The next thing we look at is the spread. So this equation, I red box column 5 and 6. The regression control for initial year's condition times the year dummy, and then we control for a firm fixed effect and so on and so forth. Then we look at the interest spread. We put the secured and unsecured together in running this regression. The online dummy captures what happened after the reform to the interest spread of the unsecured. And then the sum of the first two rows coefficients will capture the impact on the secured loans interest spread. What we find is that for both the SOEs and the POEs, there is an effect that the secured loans would have a zero or marginally have an insignificant change in interest spread, but for the unsecured loan, the interest rate increase. Intuitively, this is very appealing because if there's substitution away, and if banks, they to some extent practice credit rationings and so on and so forth, what they would do is to retain the more attractive unsecured loans, which means that those that will pay them a higher interest rate, all other things equal. And that's what we observe. The second thing is that we look at what drives all these changes. So we are looking at the interest spread change and also later on the risk, the change in default risk. And we focus on the borrower's factor, high versus low fixed assets, high versus low finance dependence industries firms, and high versus low credit rating POE firms. We focus on the POE because in the case of China, I think looking at the POE is much more meaningful than looking at both POE and SOEs. And also we run the regression by putting into separate subgroups because I can put them all together with all kinds of interaction terms, but it would be very hard to present and very confusing even on paper. Then the other thing we look at is also competition in supply. We look at each branch and ask the question, how many branches there are within a 5-kilometer radius? And if there's a lot, then there's high competition. If low, then there is some market power for them. With this way to capture, we just run the regressions, just like this one in column 6. We run it again and again and again using the POE executed loans, and what we find are the following. Factors that drive the change in the spread, meaning that the unsecured loan will have an increase in the interest spread, and the secured loan will have a decrease, is found within the high fixed asset group, is found within the high finance dependence industry firms, is found among the high credit rating firms, and is found in branches that face high competition. This says that both the demand and supply are driving the observed changes that I earlier report. Then the next thing is, let's look at the risk. So what we do here is, again, we focus on POEs because SOEs default in China is something that I yet have to understand better. And so I focus on the POEs, the private firms, and I look at the full sample. I look at the default risk and run a logic regression or linear. All the regressions came to the same result, like in column 1, controlling for all the fixed factors and so on. We find out that after the online, the minus 0.0339 captures a decline in the default risk of unsecured loan. And when you add the first and second row together, it says that it captures the change in the default risk of secured loans. The finding is that there is a decline in the unsecured. There's a decline in the probability of default of unsecured loans, but no significant change in the probability of default for the secured loans. And this again is all found within banks with facing high competition. For me, our interpretation is that this is exactly the way we'd expect in an equilibrium. By shifting away, the retained unsecured loans are those that are more attractive to the supply, to the company, meaning that they pay a higher interest rate. At the same time, they have lower default risk. Now, for the no significant change in the secured loan, we scratch our head. We say, okay, no change in interest rate, no change in default risk. So what's happening? We say, well, maybe for the same collateral, the firm and the bank will agree on a loan that is of a larger amount. So that's what we do. We look at the change in loan characteristics. We look at the volume, look at the size, look at the interest earnings, and at the branch level. And so we find the following. Look at this slide. The first column captures the total loan amount of a branch. And it turned out that after the online, go up. And the panel B shows that after the online, the average loan amount goes up. And if you look at column 2 and 3, column 2 is the secured loan, and the column 3 is unsecured loan. And it shows that it's the secured loan that drive what we observe in the first column, meaning that because of the secured loans, because of the shifting, because of more increase in the secured loan, the banks are lending out more, and for each loan, they lend out at a larger amount. And this part shows that the branches also earn a higher interest income. And this higher interest income is driven by the the total interest earning, because the dependent variable is the log of interest income, is driven by the total log interest income from secured loans. So we know that this shifting helped the banks. They like it. Then we ask the question, who are getting these loans? Who are getting these additional loans? By now, I think intuitively you expect this result. What we do is that we regress the log of secure loan to POEs. And then we divide them into the lending to the fixed asset and lending to a high fixed asset, lending to low fixed asset in the first panel. In the second panel, we do the same thing, but we divide them up into high rating POEs and low credit rating POEs. In the third panel, we divide them up into firms that borrow a lot, that are in high finance, external finance dependent industries, and firms that are in low finance, low external finance dependent industries. And the red box captures that whether we have high or low fixed asset, the POEs are getting more loans than before. And second, high credit rating POEs get a lot more loan. The rest, we don't see that. So we capture that the POEs are getting more, especially the more loans, secured loans, especially those that are of high rating. Then we have to back the question, whose access to credit goes down? And what we do is with this time there's no just POE. We look at all the loans, and SOEs are included, or we can do it SOE, POE, all the results point to what I showed you on the screen. The dependent variable. The dependent variable is is getting a loan. So we run a logit, and then we deliberately focus on firms that we suspect are on the losing end. So the first column takes online as a dummy, and the second is online cross, the low fixed asset and high external finance dependent industry firms. The second is the online, and then the online cross, low rating, high external finance dependent industry firms. The third one is to put all three variables together. And the three columns show that after the online reform, all the POEs are getting a higher probability of having a loan. The only loser turn out to be those that are lowly rated, low credit rating, and high external finance dependent private firms. So at this point, I thought maybe the losers deserve to be losers. It is a big statement, so I may be wrong, but I suspect that maybe the result shows that what we have is something efficient. The borrowers are getting more loans than before, and only the undeserving one, only the low credit rating ones are losing. So we say maybe let's look at the firm entry, and it turned out that using the firm registration data after online, the privately owned firms, enterprises, they have more new entrants. So let's put them together. We examine this paper. It's a China story, but we believe that the results are applicable to many emerging economies contemplating the possibility of adopting online reform. We use China's experience using online reform, the DID regression, to produce the results. And the beauty of adopting online auctions of bankruptcy is that it is so easy to handle. You don't need to go through a lot of legal procedures, and it generates the results that we find. Number one, lending shift towards secured loan from unsecured loans. Good or bad, we have to investigate further. Second, for the retained unsecured loans, they pay a high interest rate and they have lower credit risk, lower default risk. For the secured loan, there's no significant change in interest rate spreads and no change in default risk, but there's a higher loan amount per deal, meaning that for my interpretation is that for the same collateral, they are able to borrow more. And the drivers of the changes are borrowers with greater fixed asset, better ratings, and they are in more external finance dependent industries. And it is the market competition among lenders that press the branches to respond to the demand changes. The branches driven by the secure loan POEs, they end up lending out more and lending out more per loan, and they make higher interest incomes. For the economy-wide result, we feel that the entry has gone up, and only POEs with poor credit ratings in high external finance dependence industry see a drop in the probability of loan assets. Where this is the set our results. Thanks for listening, and I really cherish this opportunity to learn from the discussions and the audience. Thank you, Bo Hui. I will exit from my sharing.
Okay, thank you, Bernard. Great timing. So we save 1 more minute. The discussant is Professor Vikrant William, Timken professor and professor of finance, and from Graduate School of Business, Stanford University. He's also senior fellow from ABFER. And let's welcome Professor Wei. Yeah. Then maybe you would like to unmute your microphone. Hi, Vikrant. I think your microphone is muted.
No, can you hear me?
Yeah, we can hear.
Yeah. Hi. Well, thank you for having me. Inviting me to discuss this paper. I enjoyed reading it, and thanks, Bernie, for sending me the different versions of the draft as well. So the two good things are that I sort of I've done some work in the area, so I'm very positively. I'm a biased person in some ways because I like this kind of work, and I sort of very much enjoyed reading the paper. So what I'm going to do is I'm going to, 25 minutes is a long time to talk about as a discussant. So I'll try and sort of give a quick overview of what it is, and then mostly my comments will be minor quibbles about things I was not able to understand, or maybe offer different interpretations of some of the results that might be there. So I'll just put some slides. I'll just share some slides just for simplicity, but maybe a bit and then maybe go and talk more about it. Can you see this? Can you see the slides?
Yes.
Let me just make it on
full screen.
Okay. Yeah, you all can see it?
Yeah.
Yeah, I was told during early that because I have a very big screen, not everything you can see out here, but hopefully I'll try and make sense of it. Okay, so Bernie talked about this reform in India. I'm saying in China. My paper was on India, so whenever I think about this paper, I sort of I use that. That was a slip. So talked about the reform in India, in China, which essentially I look at Paul. He's constantly laughing. Paul and I went to the same graduate school as a PhD student, so it's almost it's like we're back to those days where we was laughing at each other's presentations. But let me get on. So this was a reform in China, which what essentially it did, and maybe some of these institutional details can be made more clear in the paper, is it allowed the courts to liquidate the collateral of the defaulting firm in a more efficient manner. So the way I think about it, there's a lot of discussion about the reform is reducing corruption and things like that, and this was not really clear to me as to how it reduced that. But what I gathered from the description was that it allowed for a quicker liquidation of the asset, and the auction mechanism was such that it was a competitive option, and therefore it resulted in a higher liquidation value of the collateral. Okay, that's how I see it. But there are these, descriptions in the paper about how it reduced corruption and things like that were not very clear. So I will sort of focus on this mechanism, which is it's improving the recovery rate on the collateral. And I'll say that once one thinks of the reform in that way, a lot of the results come from standard economic models, or some bilateral debt contracting models, la Hart and Moore or Bolt and Sharfstein. Any of your debt contract models, would give you that kind of a result. So essentially, if you think about it, what the reform does is it increases the liquidation value of the asset, and so you can think about it as reducing the deadweight cost that comes with liquidating collateral. And such a reform would enhance the contract space, because what it allows you to do is it allows you to borrow more, but you don't have to if you don't want. So in that sense, it's sort of an expanded contract space, which allows for more credit that is available. It relaxes financial constraints of firms. But if firms don't want that much amount, they can always borrow loans. So it's like it gives you more options. That's what I mean by expanding. And such a reform, one would think is actually a good thing. This would lead to lower cost of credit for firms, so improve access to finance. And as far as banks are concerned, depends on what model you have for banks. If the market is very competitive, then of course this just means that there will be a shift. The firms are going to dictate what they want. Banks are indifferent between offering secured debt and unsecured debt, because what they're essentially doing is they're giving some amount of financing, and what they want is to break even at the end of it. So they're sort of indifferent, on that front. And of course, they might have been credit rationing some borrowers who can now be given access to financing, because they know that in the event of default, they can get a higher liquidation value from the security that they're going to liquidate. So all that is a good thing. So I'm going to interpret, the online reform in China as is just going to be an improvement without these other changes. Okay, just the rules are the same. All that is happening is that the judges who are ordering the liquidation value, because of speedy recovery, is going to reduce transaction costs. In other words, this is going to improve the liquidation value of the asset. So I have in mind some sort of a competitive model in the banking sector, and I'm going to relax that a bit when I talk about the interesting results that Bernie and co-authors have about, this differential effect for, banks that are in more competitive and less competitive areas. Okay. So it sort of bypasses the tedious and time-consuming bankruptcy procedures that Bernie had mentioned, and third parties who were involved earlier. Okay, I think it would be useful to understand exactly what was the role of courts there if they were to delegate it to third parties. What was wrong with that? Why couldn't they check corruption? Something that I mentioned earlier. But I can see that now with the online auction, you have a higher participation, quicker participation, so it'll clear the backlog for the courts, and as I said earlier, improve on the liquidation value of the asset. The event, Bernie's gone through it in quite some detail, so I'm not going to talk about it. But the strategy is a staggered, different diff strategy, and they're going to look at a lot of interesting results on quantities of loans, interest rates, then some sort of extensive margin, and then heterogeneous effects on both lenders and borrowers. So let me give you the quick result right from the slides in the paper, which is, if you look at it from the bank's perspective, you see that the amount of secured loans to total loans going up. Banks are giving more loans. And if you look at the division between the POEs and the SOE being the state-owned enterprises, POE being the privately owned enterprises, a lot of it is coming from the POEs, and which will be the focus of the analysis later on, which seems to make perfect sense. But what you can see out here is just from this, this doesn't really tell you about the overall amount of loans that the banks are giving. But what it seems is what is very clear is that there's substitution from secured loans to unsecured loans. So in column 1, secured loan goes up. Column 2 is for POEs and focus on POEs. SOEs for other reasons that are not affected. And if you look at the substitution, it almost looks like it's a pure substitution out there. Though Bernie had later on showed when the analysis was done more at the branch level, it seemed to be the case that the branches were also giving out more total loans. So it's not just a substitution, they're also giving out more loans. And then the question becomes, is it more loans to the same borrowers or more loans to new borrowers as well? So the intensive versus extensive margin and they find both such effects, it seems. Okay. Here's what the interest spread looks like. It seems like not much is happening to the interest rates that banks are charging on secured loans. So as Bernie said, the way he wants us to interpret this table, especially column 5 and 6, is to add up column 1 and rows 1 and 2 for secured, and so you can see that there is a higher cost for unsecured loans, but on net, not much has changed for the liquids. So my overall impression, it's an important question and an important topic. As I mentioned earlier, improvement in the liquidation value, which was brought about by this reform, should expand the contracting space in the manner I talked about it. Okay, that it allows you to borrow more. All right. Now you don't have to. In that sense, it's giving you an option to get more, but you can always revert back to the old regime. So in that sense, nobody's worse off. But to the extent that some borrowers being rationed off, they're clearly better off. Okay. Now there are theories out there which talk about why restrictions on contracts can sometimes improve efficiency. Mellon and Katz is a very important, very nice paper on that in the Journal of Law and Economics and Organization. There are also papers that talk about creditor rights being too tough. Earlier we used to have things like debtor prisons to, and there was a feeling that such tough rules were sort of having a negative effect on the innovation activity. And now we have limited liability, which sort of helps with that. Of course, this paper is, as I said earlier, the way I thought it was about, debt contracting in general. This is more, I see the description as the institution description more about the liquidation value of the asset. I should add, there's also a theory of lazy banks, which can be an interesting, channel, which is if you're going to get a high liquidation value as a bank, this actually makes the banks lazy in the sense they don't screen and monitor the loans as much. So there is this feedback effect of, a very secured loan or highly collateralized loan or a loan that is going to give you enough in liquidation value generates this effect that you don't then screen and monitor because, right. So there's not any benefit from doing that. I should add that the results on competition are quite novel and interesting. I mentioned institutional details could be a bit more precise, and I couldn't get that very clear from the paper. But I know this is an early draft, so this is just nitpicking on things like how does it reduce corruption, and I understand there's a third party involved, but the third party is also involved. There's a judge that appoints the third party and can also monitor the third party. So I'm not saying that there is no role for reduction in corruption. It needs to be spelled out quite clearly. Okay. So secured versus unsecured debt result I've already mentioned. What was interesting is for me what I would have also liked to see at the branch level, there are total loans shown, but one could also do the same analysis at the firm level. Okay, I don't know whether you have balance sheet of firms, Bernie, but the way as I said earlier, I'm sticking to this model where there is a competitive market out there for credit. I know you have a cross sectional of number of banks in a given area, but I think about secured debt going up is just that secured debt is just the efficiency of secured lending has gone up. Let's put it this way. Okay. earlier there was less of a distinction between secured and unsecured debt because the lending court process meant that even if you got hold of the collateral, by the time you would liquidate it, you'd get very little out of it. So in that sense, there was hardly a recovery. And now, the efficiency of the auction brought about by bigger participation is going to be a good thing out here. So, I think that, things on, from looking at the firm's perspective, capital structure and debt structure of firms, how does that get affected? I was thinking very simply about an event study around the reform. I was like to understand, so there are these initial set of contracts that have been written, which have taken into account the existing regime. Let's say they don't anticipate this reform to be out there. And so the contracts were written and the interest rates the banks were charging was reflecting the low liquidation value of the collateral that was being pledged. Now the reform increased the liquidation value of the asset. One thing is, if the contracts are not renegotiated, and this applies to the current lending, this is a transfer to the banks because banks had priced loans in a way that they were taking into account the lower liquidation value of the asset. Now they get this windfall. So if the contracts are not renegotiated, you should see the bank stock price should go up. In fact, you do find the profitability of secured loans higher later on, right? And then the question becomes, is this from the old loans that are on the balance sheet and people can't renegotiate? Because otherwise you'd have thought in a competitive market, people would say, listen, if I don't have any prepayment penalties, I would like to give up, I'd like to renegotiate my loan because I'm paying a much higher interest rate. I've pledged you an asset which has a very high recovery rate. One should get some benefit of that. Of course, you have this nice set of results where you interact competition with, you interact this number of banks in a given region, right? And try to see the pass through of this reform. And you find that where there's more competition, you see these bigger spreads, etc. So it's consistent with that. But yeah, I think that's looking at these stock market reaction of firms. Banks would give a bit of a sense of the stuff that you were trying to do later on with who benefits from this, and separating between old legacy loans which were originated in a period where the liquidation value was a lot lower due to corruption, etc., compared to now. It would be an interesting cross-sectional test to look at this. Now there is a, as I said, I'm going to quibble a bit. There is a bit of a problem with the empirical analysis. There's something called a bad controls problem out here. I know you're sort of interacting this online with secured debt, online with lots of other variables. These are endogenous variable by themselves. The amount of secured debt is getting affected by the reform. Okay, so you have to be a bit, when you're looking at, even let's say you're looking at, later I'll talk about it, the interest spreads, for example, between secured and unsecured debt, right? The fact that the level of secured debt is getting affected and the level of secured debt will have an effect on, the pricing of it. And so a lot of these, I would have taken the pre-treatment values of these things and done the regression using pre-treatment values as opposed to the current values. It looks like you're calculating, for example, the secured, or let's say fixed asset to total assets, right? These are all getting affected by the reform. All right, just so one should be clear. It is also not very clear to me. You talk about these loser firms. Not clear why low credit ratings are getting less loans now. They should have gotten less loans to begin with. It's not clear why after this reform these are the ones who are getting the low rating. Maybe you have some sort of a GE model, GE effects in mind, where you have some sort of a limited supply of credit by banks, and so if they give it somewhere else, then I don't know. It was not so obvious to me why this effect would be there. Let me say a couple of things on the cost of loans. I already talked about the what I thought was a bad controls problem, yeah. So there are these two things happening out here, which is it seems like from a firm's perspective, of they're getting more secured loans. They prefer more secured loans because secured loans now are sort of relatively cheaper. Okay, so unsecured loans, secured loans have gone cheaper. Now, clearly, unsecured loans. So if you were to apply within the debt, right, more secured loans being given and less unsecured loans are going to given, just now the quantity changes will generate some of these results that you have, because just like we talk about Modigliani Miller applied at the firm level, when we say what happens to if we increase the amount of debt, what happens to the cost of equity? We say that debt is senior, the cost of equity would go up if you increase debt, but the overall weighted average cost of capital will not get affected. So the cost of equity would go up, but the weighted average cost. The same thing in this, it would be interesting to know what's the cost of debt, what's the cost of capital, what are we talking about? It's true that they're taking on more secure debt. I think that this is partly driven by secured debt being cheaper. Unsecured debt now becomes more junior. Therefore, the price of unsecured goes up for that reason. So it's hard to, maybe looking at the overall cost of debt or the cost of capital, what happens to the total, I think there's this very interesting things happening at the debt structure level, which would be interesting to tease out. I did talk about the renegotiation of debt contracts, because without that, there's a big transfer to the banks. I also mentioned about competition also being an endogenous variable in the following sense that, earlier when liquidation value was low, banks would have to worry about whether the borrower has borrower's creditworthiness, because screening the borrower was very important. Now, imagine if you have a very good online auction and whenever they pledge collateral, you can liquidate it easily. This means now that the information has soft information is less valuable now, which means a lot of banks can lend. So you can think about competition for borrowers is actually getting affected, because it's not just going to be the folks that had some private information which they got through screening those borrowers that are in play. Now anybody can lend, because as long as you give a collateral, you're eligible for lending, and the lenders feel comfortable knowing that there's a procedure out there which allows them for high recovery rates. So they are able to get their money back. Okay, so
you have some more minutes.
Okay. And so the question is, did the reform increase bank competition? And so you have all these, endogenous variables, which are very interesting, but, looking at these, this is also very interesting. And competition is a tricky thing. You can say 5 banks is too little, but if you believe in a world with Bertrand competition, 2 banks are enough, to get what is a competitive outcome. There's also an interesting thing to look at, which is, we always talk about the role of bankruptcy law, the law of, creditor rights, in largely in the context of bilateral lending between a borrower and a lender. There's another thing which the bankruptcy reform tends to do is reallocate assets from less efficient firms to more efficient firms. And so what could be happening out here, also another benefit of this reform, is that the fact that the liquidation value is high, it sort of creates incentives for the creditors to liquidate it, and also generates good behavior on the part of the borrower, because earlier the borrower could be thinking that, there's a commitment problem from the part of the lender, some sort of a soft budget constraint, that if there's a default, the creditor is not going to liquidate it, which then leads to a different type of behavior. Now with the high liquidation value, you of course have a commitment to liquidate, because they can get a good deal from that. But what it also does is it allows for these scarce assets to be reallocated in the economy, and there could be that element from which you could be getting some sort of a positive effect overall. G effects is something I think you should think about. The general equilibrium effects, they are sort of papers. There's a very good paper by Sujata Visaria and co-authors in Econometrica that looks at these debt recovery tribunals in India. And essentially the idea is that if banks have a limited supply of funds, Okay, and so when you talk about the supply effects, you need to think about, what was happening before, because apparently banks probably have a limited amount of deposits, so they have a limited amount of funds. Now banks can do, in a world with a lot of asymmetric information, and if banks are not comfortable in lending, they can probably invest in treasuries, lend to credit-worthy borrowers. Now comes the collateral law, which says, you know what, I'm more comfortable as long as you pledge some collateral and I can liquidate the asset of the firm, I'm willing to lend more. But with the limited supply of funds, now you get some interesting GE effects, which is more people are competing for these funds, and therefore they're going to be winners and losers from this as well. Okay. I know I'm running short of time. Just more of questions rather than anything. You have this analysis on defaults. Most countries have loans with cross default clauses. And what this essentially means is that a default on one, so this applies even for multiple creditor, but I'm pretty sure it applies between secured and unsecured for sure within the same firm. But maybe China has some different laws governing this, and this needs to be spelled out. But the idea of the cross default clause essentially is a default on one loan automatically triggers default on all the loans. Okay, so this idea of defaulting on secured versus unsecured with the same lender, I was like, I think it's an institutional detail that needs to be clarified, and it would help with the interpretation on. I already mentioned this, that the liquidation value affects the incentive to default, and your result on no default on secured debt is sort of seems to make sense based on the incentives to if it's the soft budget constraint issue that I was mentioning earlier. Okay. Let me conclude. Bernie, we can talk more after this at some point and discuss some of the other things. But I thought this was a very interesting papers. I think the results are consistent with how we would, what economic theory would predict. I've offered some very minor quibbles on the empirical strategy, using an endogenous variable and thinking about pre-treatment variable to sort of to address that concern. I found the result on competition interesting, and I think it also combining this with some event studies to see whether if the reform was a surprise, especially the initial one, initial phase of it, because later on probably it was more anticipated. Okay. But I enjoyed reading the paper and would definitely recommend it to others. And please keep me updated with the developments. And thank you once again for inviting me to discuss this paper. I'll stop here.
Okay, thank you, Vikrant, for the great discussion. And Bernard, maybe you would like to give some response first. I think we are going to wait for our audience for some questions. Yeah.
Oh, sure. Well, thank you. Also, I would invite my co-authors to chime in anytime. I want to first thank Vikrant. I really learned a lot from all the points you made. First, I want to thank you for helping us to put the paper in the context of the bigger literature. And because of 25 minutes, so I did not spend a lot of time on the institutional details. And you have done that for us, and thank you very much. I want to focus on and then about in the writing, we need to clarify more on the institutional details and how this may reduce the corruption problem. We'll surely do that, and we actually have a toy model before we do that, but we throw away the toy model. So let's try to clarify that part, and thanks for your constructive input on that one. Then I want to think about the following. What we have is trying to just come up with a set of empirical observation first. And I think Vikrant very constructively pointed out that we need to work further on the firm level capital structure issues, and also including the cost of capital, and also pointing out that we need to work further on the reallocation issues and competition among borrowers. For sure, we are thinking about what we need to do next, all in one paper, or write a sequence of paper. And your remarks encourage us to just write more on the issue of capital structure, cost of capital, market efficiency, especially on reallocation and the effect of competition among borrowers. And then the pre-treatment, yes, I totally agree with you. We easily can do that. We did a little bit of that when we look at the initial, meaning all 2011 initial firm characteristics, to use that to control. But obviously, for some of the variables like credit ratings and all this thing, we need to make sure that we avoid the bad control problem. Thank you. And then I will work with the team to clarify the cross default clause issue. Overall, all well taken. Thank you for your constructive input. Your input is helping us to improve the paper. Thank you. And I wonder if my co-authors have any comments, any response.
Yeah, we can also see whether we have comments and questions from our audience. And Paul and Michael, and yeah, I think Michael raised you. Michael, would you like to unmute your microphone?
Oh, great. So first of all, thanks for the great presentation and discussion. I also learned a lot. I want to pick up one thing that Vikrant mentioned in his discussion: the heterogeneous effects on low and high rated firms. I think this is very important, as Bernie said in his presentation. That it helps us to understand what's happening at the aggregate level. But on the other hand, I'm also wondering, what's happening there. Put aside, I think everybody agrees that this online auction is going to lift liquidation value. But suppose, it also reduces the cost of liquidation. Then does it actually have a larger positive effect on those low-rated firms that are more likely to default? Because when you think about it, they're more likely to default, and then the expected cost of liquidation is actually getting lower for that type of firms. And these firms should actually benefit more from this legal reform or online auction system. So that's the kind of thinking along the side of the cost of liquidation. Another thing is thinking about the collateral they put down. If high-rated and low-rated firms both put on, housing as a collateral, which has nothing to do with, their businesses, and then why, low-rated firms actually they are negatively affected. So it has to do with the assets as a collateral. So one possibility is that this auction mechanism also reduces information friction. Right. So previously they don't know much about the low-rated firms' asset value and liquidation value, and through this auction, they get more precise information. Therefore, those the better-rated firms they benefit more because they have a really high-quality collateral, which was undervalued before without this auction system. So that's kind of my 2 cents. But once again, thanks a lot for the very interesting project. I learned a lot. Thanks.
Do you want me to respond now? I really like the combined comment of Vikrant and Michael's. I have some response, but I also see Paul's hand. Bo Hui, you want me to respond now or later?
Yes, please go ahead.
My thinking is that as I heard Vikrant and I hear Michael now, what I think is that in this change, those low rating firms will have to put in more collateral. Okay, would stand a better chance, a higher chance of losing their collateral. So let me just put the following together. First, Vikrant's paper much earlier point out that when you make the changes, the borrower may hesitate to put up their collateral because the banks the lenders can seize the collateral and liquidate it fast, may not put to the liking of the borrower, and there's a contractual change and so on and so forth. Now, the borrower would worry that if I go to borrow, I lose my collateral fast and very likely. In the past, in the case of the Chinese saying "not lao lai," if I don't pay, I have 3 months as a 3 months as a time period that I can scheme and scream and so on. I can, for example, if I put my mall as a collateral, I can continue to rent out, reduce the maintenance, and that 3 months later the value of my collateral go down, but I already used that 3 months to recover a lot more for myself as a borrower. So under the law change, this is reduced. If that is reduced, I would be less likely, less prompt to put my mall as a collateral. And this, I think, are the changes that show up in the data, which I think Vikrant and Michael have in mind about the change in the contract value and the change in the dynamic between the borrower and the lenders in the case-by-case negotiation. This is my suspicion, and I feel that this can explain the data as a result, and we need to write more carefully, dig into the context carefully, and push the pencil and write things out more carefully in the paper. I don't know if I have understood your comments properly, but these are my response.
Okay, thank you, Paul. I think.
Yeah, a very quick one. I think the firm banking relationship is very important, but which you probably haven't explored here in the banking paper, or you extended the firm level paper, right? Because for firm side, if from a banker side, if now I know I can liquidate the collateral as soon as possible, then actually then it really, just like Vikrant say, it doesn't really matter who come here to borrow. So my inclination to my old customer may be less. So you can look at the new customer, the old customer composition, right? And from the first perspective, that actually I know as long as I have a trustworthy collateral, I can get lending. So I will probably approach more banks, right? So I may have a more collaboration with the new banks. No, just some thoughts here.
We tried to look at the new loans, new borrowers, and so on. And the effort is we are continuing the effort. The trouble is that really we need to go deeper into the institutional details and also the nature of the data to understand better what is called as new loans and what is called as new borrowers and so on and so forth. And there are a lot of institutional details that in this discussion point us to dig deeper, including the cross-default clause and the new and old. And also, I really appreciate in general the thoughts about this change the equilibrium, change the nature of the contract. There is old contract, new contract, and how they are changed. And also this changes the cost of capital and change, but not homogeneously, not all the same, not for all the bank, not all the banks face the same change in cost and capital, and also whether we can say more about the efficient allocation of credit and of resources. Like Vikrant say, are we moving resources away from which firm and so on? We need to be more careful about this. As we told the organizer that we have to work hard to improve the paper. We benefit from all the comments, and we have to improve the paper and then share and incorporate your comments and share with the discussions and the question and Michael and Bo. I don't have an answer to Paul thing. We tried, but we are not able to get much yet. We may have to get better data. We may have to improve our data.
Okay. Maybe I would like to ask two quick questions. The first thing, Bernard, is because the experiment relies on the staggered introduction of online collateral auction market in different cities. So I wonder whether you have any heterogeneous measurement of this liquidity in different cities in China in this online auction market. So in some cities, this online collateral auction is more liquid relative to other markets. I'm not sure whether you have this online auction market data or characteristics you could quantify like this liquidity. The second thing is like, I remember you have some tests regarding the distance between the bank branches and the firms. I also checked the DeepSeek and also some AI tools to check. I realized actually from 2011 to 2015, actually Chinese banks, the branches expanded over the period from 2011 to 2015 a lot. So this period probably overlapped with this staggered introduction of online collateral auction market. So given that there's data about the Chinese banks branches location or establishment date, probably you can conduct a validity test to show that, or placebo test, show that there's no effect from the supply side. Yeah.
First, about the online auction data, maybe my co-authors would have more informed answer. We hand collect the data, and to use the data to do a more extensive study on the change, I think is worthwhile, and I will discuss with them. Somehow their face have not shown up on my screen yet. The second thing is about the dynamics among the banks. One of the reasons that we focus on branch level as a unit of analysis is that we have in mind about the banks expanding their coverage and all this, the suppliers making many other changes in addition to simultaneous with this adoption of online auction. We try to avoid that problem by looking at the branch level data. I don't know if that's adequate or not. If you have any further thoughts, please share with us. But we are mindful of the change, and that's why we use branch level data in our in the latest segment of the paper.
Okay, thank you. Let me check whether we have further questions or comments. Given that we up to the time. Okay, no more additional questions, and I would like to thank our presenter and the discussant, and also our online audience, and also our panelists. Thanks so much for attending our ABFER web seminars series on capital market in China and others. Okay, thank you.
Well, as one of the organizers, I also want to thank all of you, especially the chair and the discussions and Michael and Bo for raising interesting and useful questions. ABFER is going to have the main meeting in May, and the team is very busy in preparing that meeting. So we will resume after the May meeting, which means in June or July. I want to thank you all for participating. Thank you, and I'll see you after the main meetings in ABFER. Thank you very much.
Thank you.
Bye.
Thank you.
Bye.
Bye, Paul.